Perfect. Thanks, guys. Thanks for joining us tonight. I just wanted to recap on what we've been through the last few weeks. So quick summary. We spoke about our money story, money mindset, really understanding how you manage your money as well and where that all comes from. Then we spoke about goal setting, how to goal set, talking about the consequences as well. Then looked at your cash flow. So your expenses and your income coming in, how it's getting allocated, different methods as well to budget. And then we jumped across to home loans, what to look for when you review your home loan, and probably more importantly, the different debt repayment strategies you can consider to repay your home loan quicker than the 25 or 30-year term that you normally get from a bank. Week 5, we jumped across to investing. We spoke about all the fundamentals you need, diversification, dollar cost averaging, asset allocation. And then we had just dropped a few days ago was our investment expert. It was a bit delayed because of his compliance and legal team had to go through the interview to make sure he didn't say anything that reflected poorly on the company or that he gave away all their secrets. So that's now live and uploaded. So feel free to have a listen to that. It does get pretty technical in some of the conversation. So if you've got any questions, feel free to just shout out, drop me an email or send me a message. Last week, we spoke about superannuation, the different things to consider, the tax environment in super, why it's so important, and then looked at some of the investment options again, and really what is a balanced investment was probably one of the key takeaways that we spoke about there. This week, we're talking about insurance and whether we need it or not. So do we need insurance? Oh, no, we don't. So if you're healthy, you never get injured, you never fall ill, or you never pass away, then you probably don't need insurance cover. However, most Australians will require some cover. So there's 2 ways to approach insurance. You can either self-insure, which means you save up, you put it in investments, you're putting things away for a rainy day for when an event occurs, or you can outsource that to an insurance company and buy an insurance policy, which you pay for then. So why is insurance important? Not sure if you guys can read that on the screen. So we've got a little map here of what we do with our clients. So their income comes in and then it gets split between the mortgage, their investment property, investment portfolio, their super, and then bit comes out for tax as well. So all their income is generally accounted for. So all income coming in, whether it's living expenses, whether it's your mortgage, it all gets accounted for. So what we tell most of our clients is insurance sits over the top because you've actually accounted for all your income. If something was to happen to you, if you were to become injured or ill or even pass away, then this income dries up, which means the home's at risk, your investment property's at risk, and all these other goals that you have associated with these investments are then on the table to be taken away. So it's more as a safety net to really bulletproof your financial plan that you're about to set up. So why is insurance important? Well, when we speak to our clients, we talk about if they become injured, ill, or pass, how would they like to leave their loved ones? Financially, would you like to leave your family better off, the same, or worse off? So what do we mean by that? So to leave your family better off than what they are now, you may have a life insurance policy that covers your mortgage and maybe 1 or 2 years worth of living expenses. So you're leaving your family better off. They're not struggling. They don't have to sell their house. You don't have to pull your kids out of school and move somewhere cheaper. The same may be just to meet the next 4 or 5 years worth of mortgage repayments, living expenses and things like that. Worse off might be something like having no insurance at all and possibly have to go to GoFundMe pages or something like that to really ask for support from people. So you've got no security over your mortgage being paid, your living expenses, or how your partner or yourself, your income is going to be replaced. So there's a few types of personal insurances which we discuss, which are really important to your whole financial situation and your wealth, especially when you're growing your wealth. Life insurance, total and permanent disablement, income protection, and trauma cover. So they're the four main types of insurance that most of our clients look for when they're doing their financial plan. So I want to dive into each of them and just explain them in a bit more detail, give you an example. If you've got any questions throughout the process, let me know, jump in, and happy to help out where we can. So life insurance, pretty much when you pass away, the life insurance company pays a lump sum to your family or your beneficiaries. So that's exactly how it works. Very, very simple. There's no special caveats or anything like that, no hidden clauses like some of the other policies may have. Obviously, if you're dead, you're dead. There's not too many other ways to get around that. There is one or two clauses in there about terminal illness. So if you're 12 months away from passing away, so if your doctor says you've got terminal cancer and you've got less than 12 months to live, the insurance company will pay out life cover then as well. So should you pass, your family will receive a lump sum benefit. So that just means whatever you're insured for, whether it's $200,000 or $2.5 million, they'll pay that out as a lump sum to your beneficiaries. So why do people look for life cover, or why do they take it up? The main one is to cover their mortgage. So it's pretty critical for most families. If someone was to pass in the family, they want the mortgage to be paid off, so the family has a roof over their head for as long as they live. Another one is to have a lump sum to replace the income. Say if the main income earner was to pass away, having that income to replace them. Another one I've seen done recently is to support children's education. So we see some families that want to send their kids through private schools that can get expensive. So having the funds available, should someone pass, to still send your kids to the private schools, if that's your goal. Another one is to meet living expenses, whether it's 1 year, 2 years. Generally, that's so the family can grieve and they don't have to go back to work the next week after you pass, or 5 or 10 years. We're seeing some other people put together, really just to give the family that breathing space, the comfort, that financial security and financial freedom that we're talking about in previous weeks as well. So this is one example I had a few years ago. So Scotty, I was 24 years old, and my best mate, Scotty, had the world at his feet. He was a diesel mechanic in the mines, earning over 200 grand. He was engaged, and the girl he was engaged to had 3 kids of their own, which Scotty took on as his own as well. He was away with friends for the weekend, having a good time, when he had a heart attack and passed away. As his friend and financial planner, I got to experience things from both sides of the fence. So there was $300,000 life insurance policy that was split between his family and his fiance, which really enabled them to set themselves up. So put deposits down for houses and things like that. But $300,000 is not a lot of money in this day and age, especially when houses are, $800,000, $900,000, $1 million, especially in Sydney. So yeah, but for a 24-year-old to have any life insurance was a pretty big deal, because most of my friends around that time didn't have any cover at all. After this experience, I increased my own life insurance. So as a young fella, you don't really believe in insurance. It will never happen to me, that kind of bravado. However, we all know of someone that has found difficult times that have turned to GoFundMe for support. Um, I'm pretty proud, and I don't really want to put my family through that embarrassment of having to ask for help. So I've taken out $2.5 million of life insurance. Well, my thinking behind it was pretty simple and straightforward. So my family could purchase a $1.2 million home outright, and then they could live off 100K a year for the rest of their lives if we invested the 1.3 million. So that's what I've put in my will as well. Exactly that. So that will get followed if I do pass away in the next 30 odd years before I cancel my life insurance policy. So I've chosen to leave my family in a better off position when I pass. So question for you guys, what have you chosen for your family? So the second type of insurance is total and permanent disablement. So that's when you become permanently disabled. The insurance company pays out a lump sum to you, and then you're able to spend it with your family. So a bit more detail, many people look for TPD or total and permanent disablement cover to help repay the mortgage, medical expenses, because when you do become disabled, medical expenses are huge. Also, in-home care, that's a big one as well. So rather than your spouse having to look after you, getting a nurse or someone to come into your home, medical equipment, wheelchairs, disability accessible cars, shower equipment, home renovations. Most houses aren't built for wheelchairs to come through. So renovating your house or buying a new one to meet living expenses as your spouse may need to give up work and become your full-time carer now. So pretty crazy situation to think about. We haven't seen too many disability claims. However, we did have one a few years ago. So we had a client that was 38 years of age. He was married with 2 kids. He was a tradie. He surfed every day. He was super fit. One day he went with his family to one of those jumping play centers where they've got hundreds of trampolines, where you can do flips into the big foam pits. Our client performed a huge backflip into the foam pit. He went straight through all the foam and hit his head directly on the concrete floor beneath the foam. He became a quadriplegic instantly. He had $1 million of TPD cover, which was a godsend for him and his family. However, as he explained to me later, it was not nearly enough to meet the medical expenses and the equipment he required. After this case as well, I increased my TPD cover to $2.5 million. So similar to the last process I went through, allow my family to purchase a disability accessible home or somewhere that's wheelchair friendly, along with having $100,000 in income for the foreseeable future, mainly for my ongoing care. As I explained to my wife, I don't want to burden her with having to bath me and care for me every day, especially when I can employ a beautiful Swedish nurse who will be able to bath me and care for me each day. So that's what I've done. But in all seriousness, if I become disabled, I don't want to put additional financial pressure on my family. So it's going to be a hell of a roller coaster if it was to happen, but you don't want that additional financial pressure. So if you were to become disabled, what financial pressure will this put on your family? Then we've got trauma cover. So there's over 50 trauma events. If you meet one of these trauma events, then you get paid out a lump sum as well. That lump sum goes to you and your family. So the main trauma events that it covers are cancers, heart attacks, and strokes. So they pretty much cover most of the 50 trauma events. Many people look for trauma to ensure that all their medical expenses are met, especially with the cancers. If they're specialist or trial treatments or medication that you need to get hold of, and it's outside the pharmaceutical benefit scheme or your private health fund, it may be super expensive. But if that's going to save your life, people want to pay for it and want that opportunity. So having this type of insurance allows you to do that without dipping into your mortgage more or selling off your house. It also allows you to meet your living expenses as you and your spouse may need to give up work for some time. So 3 years ago, we had a client that was 34 years of age. He was married. He also worked in the mines. One day he went to the doctor to check out a lump in his leg. It was skin cancer. He went through surgery and treatment. On top of that, he had chemo, radiation therapy, and he ended up having 4 surgeries to remove the cancer from his calf. He lost most of his calf in the end. However, the trauma cover payment, with the trauma cover payment, he was able to cover his medical expenses, rehab, and also a nutritionist. So he wanted to get his health right as well. So I've seen this so many times. So how many times have you guys seen someone jump on GoFundMe page due to cancer or another trauma-related event? So how would you and your family feel about jumping on a site like that, asking for money and support from strangers, family, and friends? How would you like for your family to deal with a trauma event? Do you want to leave them with financial pressure, or would you care about the focus being on your health and well-being and spending time together? Now, the last one is income protection. So this one's a bit different. So income protection covers you if you're injured or if you're ill and you can no longer work. They pay you a monthly amount, a bit like your salary, to replace your salary, up to 75%. And that gets paid to you. So many people look for income protection to make sure their living expenses are met and their mortgage repayments are met. Income protection only pays up to 75% of your salary. So what the insurance companies are trying to do there is, if they gave you 100% of your salary, no one would go to rehab and try and get back to work. By giving you 75%, you're still missing out on that 25%. So they're trying to entice people back to work and off getting claims from the insurance company. So a quick example, we had a client in their 50s. He was married. He was self-employed, a pool technician. He had a heart attack, spent 6 weeks in the hospital, and then 12 weeks recovering at home. Obviously, being self-employed, his whole business stopped, his income stopped. His wife was also working in his business, doing the administration and booking all his jobs, so her income stopped as well. But he got paid out his trauma insurance policy, which met all his medical expenses. However, he still needed to replace his income to meet his family living expenses, so to pay for his mortgage and things like that. So income protection was paid after his small waiting period, which enabled him to support his family. This allowed them to all focus on his health rather than the financial pressures. So there's a common theme from all these insurance policies talking about A, the financial pressures that any of these injury, illnesses, or if you do pass, put on your family, and B, where do you want your family's focus to be? On you and your family, or on money and finance? So if you had to take time off work due to injury or illness, how would your family be supported? What would your family, would you want your family to be worried about the financial pressures or focus on your health and spending time together? So you guys have any questions?
So with my super,
Yep.
It says that there's a component of life insurance and total permanent disablement and all that sort of thing.
Yep.
Is that sort of last resort sort of thing, and you recommend getting the insurance on top of that?
No, that's perfect. That's exactly what we're talking about, Al.
Okay.
So, actually, we jump into the next slide, and we actually talk about you can own it personally or via super.
Okay.
Your insurance policies. So, yeah, that's perfect. Owning through super has its advantages and disadvantages, and I'll go through them in a sec. But yeah, that's exactly what we're talking about. So life insurance, especially younger people, it doesn't affect your cash flow when you chuck it into super and have your super pay for your life insurance policy. So if anything was to happen, your insurance provider pays it to your super fund, who then pays it to your beneficiaries or your family. So really good, cheap way that doesn't affect your personal cash flow, especially when you've got a mortgage to pay. And like we heard there with Al, kids as well, raising kids as well, which can be super expensive, I'm finding out. Any other questions, guys? No? Perfect. So many people don't really even look at insurance as they believe they can't afford it. So exactly what we're just talking about then. However, insurance can be paid personally or via your super fund. When you pay via super, you're not affecting your personal cash flow, which I just explained. However, you are reducing your potential retirement benefits. There was one client that said to me a few weeks ago, if I pass, what good is my retirement benefits to me anyway? Let's get the life insurance. So there's a number of things to consider. So the first one I go through with my clients is cash flow. Can you afford it personally, or can we structure things within superannuation so you've still got a similar amount of cover? The other thing is taxation. So paying premiums. Certain insurance policies attract tax deductibility. So income protection paid personally, you get a tax deduction for the premiums. Whereas life, disability, and trauma cover, when you pay them personally, there is no tax deduction afforded to you. If we jump over to super, your life and disability cover is tax deductible, and so is your income protection. So based on the policy terms, trauma cover is not available through superannuation because sometimes we see policies that would get paid out, but then the superannuation fund would not be allowed to release it because you haven't met one of the super funds terms and conditions to release money. So it gets a bit complicated, but yeah, more or less trauma cover is not allowed to be held through super. So that was the premium side of things. If we jump over to the claim, so when you claim, make a claim on your insurance policy, there are different taxes payable. So life insurance, disability insurance, and trauma insurance, when you receive them in your personal name, there is no tax paid. It's zero tax. Income protection, you pay tax at your marginal tax rate. So as we discussed with income protection, they pay up to 75% of your salary. So that will come in each month that you're on claim. And just like you would with your salary, you would pay tax on the money you receive. If we jump over to super, life insurance, obviously you're not receiving that, but depending on who the beneficiary is, they may or may not pay tax. So if it goes to your spouse or your child who's under 18, there is no tax payable. If it's someone outside of that that is not financially dependent, there may be tax payable. TPD, depending on how that gets paid to you, potentially there is tax as well. And income protection is exactly the same. there is tax payable when it gets paid to you. So that's the taxation side of things. Then we go to the claim side of things. So this is what I was trying to explain earlier. So when you claim an insurance policy, say one of those events we discussed earlier happened to you or your family, if you own the policy personally, it gets paid straight away, straight to the beneficiary's name, to their bank account. No questions asked. If you have your policies held within super, there's an extra step. So the insurance company pays the amount of the claim, pays it directly to your super fund. Your super fund then holds the money. It sits with them. Then you need to meet the condition of release for your super fund to pay that money out. So there's a number of conditions of release. One is death, one is retirement, another is total and permanent disablement. So you need to meet one of those conditions for your super fund, then to release the insurance money out to you, the proceeds. I've seen in the past where some clients have got stuck. The insurance company said, yes, you meet all our conditions, we'll pay out to your super fund. The super fund gets the money and says, you don't meet our conditions of release. We're not releasing the money to you. So despite the condition of the client, their health, the money was not able to get released. So there's different ways we now structure some of these policies to get around that as such. So we put a majority of the policy inside superannuation, especially with clients that don't want to affect their personal cash flow. And then we put all the bells and whistles outside of superannuation in your personal name. So that way, the money never gets stuck in super. If you do meet the condition, you go straight to the bells and whistles, which you own personally, and gets paid to you personally. If you meet the bigger part of the policy, which is death or your total and permanent disabled, that gets paid out in super, and then superannuation releases that to you. So yeah, two different types of policies, different structures as well, but we've just got to be careful of the superannuation environment and make sure they release any insurance policy or any claim that we have on an insurance policy inside super. As I said, it can get complex. I try to make it as simple as possible, but I may have lost a few people there. Any questions on that side of things, guys?
I've got a quick one for you, Matt.
Yep, fire away.
It's a bit of a curveball. So what you were just saying there before about tax and that on your own life insurance if you got paid out.
Yep.
Obviously, that's very different if it's through a death of parents and you're a beneficiary as part of that life insurance.
Was it held inside super?
No, it's a separate policy.
So yeah, as we said, if any policies held personally, they're tax-free and get paid directly to the beneficiary. So life insurance only becomes an issue when it's held inside super.
Yeah.
And it's paid to an adult child or someone that's not financially dependent. So for yourself, Gary, if you were receiving a benefit now, that life insurance policy was held in super, you're not financially dependent, you're an adult child, as the definition would sit, so that there may be tax consequences for you.
Yeah, right. Cheers.
Okay. So generally we see that as well when, also with super funds, we spoke about it last week, or the inheritance tax that we spoke about, or the death benefit tax. So when you die, your taxable component of super is then taxable if your children are over the age of 18 and they're not financially dependent, or you pass it to someone outside your family. So the insurance landscape. So not to scare you, but the insurance landscape at the moment does not look good. So a bit like the private health fund market, who religiously increase premiums, the personal insurance landscape is very, very similar. So 83% of Australians are underinsured. So they don't have enough insurance. So over the last few years, we've seen rising premiums, anywhere from 7 to 50%. So some super funds, I even looked at my wife's super fund probably 2.5 years ago, and her premiums were up 33% on the previous year, which is huge. So at the time she was 28, 29, 28. So premiums should not be going up that high for a 28-year-old. But some super funds, they lump all their members together. Say they've got a million members and they're getting lots of claims, they've got to try and offset it. So they start raising premiums across the board for everyone, regardless of your age, your occupation, if you're a smoker, if you're overweight, if you work out, all that type of thing. Whereas we find if you go directly to an insurance company, they'll come out, they'll do a blood test, they'll weigh you, they ask you 101 questions about your family history, your personal medical history, even your activities, whether you do any risky activities, and they just insure you. So we find when we go direct to insurance companies, we're not finding those large jumps in premiums each year. There still are jumps, as we will discuss a little bit further down, but yeah, they're not as big as some of the super funds we've seen over the past few years. At the moment as well, there's huge discounts available for new customers. So as we say to all our clients, it's worth reviewing your policy every 2 or 3 years, even to make sure you're still healthy as well, because we find huge deductions available. Because all these insurance companies are trying to get new people into their market. One of the main reasons why premiums are increasing is the mental health claims. So 20 years ago, they had hardly any mental health claims. Fast forward to 2021, and that is their highest claim, is in mental health, especially after COVID, where people were locked up, or those people locked up alone as well, or with their families, screaming kids, all that type of thing. It's skyrocketed. It's gone through the roof, which makes it unaffordable for the insurance companies to continue to pay out. There's also been huge cancellations. So as I said earlier, rising premiums, we've got anywhere from 7 to 50% we've experienced in the past. And people are just saying, that's it for me. I haven't needed it so far, so I'm cancelling. With people cancelling, the insurance companies have less money to pay for everyone else that is claiming. So they have to put everyone's premiums up to try and balance their books, if that makes sense. So a bit like a bookie at the races. They take huge amounts of money on one horse. They have to balance the books with everyone else. Also, their main salesman was people like myself, and there was a reduction in advisor commission, which means less people provided advice. So at one stage, we were receiving 110% of the premium, the first year's premium, and that's reduced to 60% now. So most advisors, I would say 85 to 90% of financial advisors say we no longer do insurance advice because it's not worth our time for the money we receive. And most clients don't want to pay for advice either on insurance policies. Also, one final thing, there are changes to income protection policies coming in October. So income protection policies have been the main policy that has got smashed by mental health claims. So we've seen the government step in, the federal government, and say, this is unsustainable, these products are unsustainable, you guys aren't making money, you're losing money, we have to change the whole landscape of income protection policies. So that's still getting fleshed out, but from memory, they are paying 75% for the first 2 years, and then it drops down to 60% for the next 3 or 4 years thereafter. At the moment, you can lock in policies to age 65, which pay up to 75% of your income. So we're going to see a few changes. Few people rush in to get income protection policies as well in the next few months. But as we said, 83% of Australians are uninsured. So there may not be a huge rush as the government may expect. Any questions, guys? No. Perfect. So main thing to remember, review your insurance policies. Whether it's held via super, personally, have a look what you have, what you're paying for, what the premiums are, how much your premiums have gone up in the last 12 months, the last 2 years, the last 3 years, and then even shop around. Have a look online. There's other providers out there that can do everything online for you, and just compare the market and see what you can get. Make sure you're comparing like for like. There's a number of policies like income protection, for example, where you can move the waiting period. So you may be on a 30-day waiting period, but the one you compare it to may have a 2-year waiting period, and that will significantly reduce the premium. So it can get technical, but have a look. Make sure your mortgage is covered at the least for your life cover or your life insurance. Consider whether you hold it through super or personally, depending on your situation, and your personal cash flow as well. So I'll chuck the recording up in the next few days. So you'll have a few more questions and tips I'll give you about insurance when you're looking at yours. If anyone wants to send through their statement, I'm happy to have a look, send it back to you and say whether you're on the right track, keep it as is, or maybe have a look around, and then we can go from there. Any questions, guys, to finish off tonight?
No, good. Thanks, Matty.
Thanks, Al.
All good. Thanks, Matt.
Thanks, Matt.
Thanks, Kath. Thanks, Gary. Thanks, guys. Have a good night.
See you, mate.